We're back from Thanksgiving. I know the lighting is a little bit weird, but we've got a lot to talk about today, so we're just going to focus on the content. The last 3 weeks, according to Bank of America, we've seen net bullish buying, meaning more buyers than sellers the last 3 consecutive weeks. That means that sentiment is quite bullish right now, and we've seen that reflected in the charts. We got right back up to 4,000. We chopped around there. Now we're making a little bit of a test below 4,000. We never really solidly held above 4,000. We actually only closed one day above 4,000, despite being above 4,000 several times. And the one day we closed above 4,000 was that Thanksgiving Friday shortened trading session. Where does the market go from here? What do we think? And what are we thinking about the fundamentals? There's a number of things we're thinking about the fundamentals. Bank of America said 3 consecutive weeks of bullishness, a lot of institutional buying. If you hear a lot of the chatter, and the chatter seems to be driving the market right here in this short-term move, that doesn't seem to be fundamental based, that we'll get to in a second, you'll hear a lot of talk about this so-called year-end rally around seasonals and liquidity. To me, this sounds a whole lot like 90% of funds are down this year. They've lost money. They've told clients to be buying losing assets that were overpriced. And they have egos. And this is something to know because we're humans. We're not perfect. And guess what? We all have egos. And they're caught in this trap of trying to mediate their losses for the year because their clients are considering dumping them and leaving for somebody else. And they're calling for a year-end rally. They're buying. They're trying to get a piece of this year-end rally because they can see it. They can taste it. Finally, I'm going to be vindicated. And guess what? We don't think it's going to come. Why do we not think it's going to come? Well, there's been a weird move the past couple weeks. The Federal Reserve, Jerome Powell, and basically every member of the Fed has said verbatim at some point that, fine, we're going to go slower. We're finally in restrictive territory. We had to accelerate into restrictive territory because that's just the very start of possibly being able to do anything about inflation. So they did historical rate hikes at a historically fast, ridiculously fast, only beaten, I believe, one other time in the Volcker era after a decade of inflation pace. Extremely fast into restrictive. People have ran with the fact that they now want to say, oh, we're going to slow down a little bit. They're not slowing down a little bit. I mean, they are slowing down a little bit, but this is not a dovish thing to run away with. What they're talking about is slowing down, but increasing the final point. They're saying they want to increase the final point. That's what matters. What are interest rates at? How high are rates going to go? Because that affects the risk-free rate of return and affects the prices of all other assets. That's what matters. Not the pace. The pace is going to slow. It had to slow at some point. Not a big deal. Rates are going high. That's what the Fed's talking about. That's what the Fed said yesterday. That's what the Fed said last week. There's a whole lot going down with that. The Fed is getting more tight. Despite that, despite the Fed, Powell saying rates are going to go higher, Bullard saying the same thing, and I believe even a different guy, more middle guy, saying that rates are going to go higher. Somehow, the 10-year was below 3.7% yesterday. Mind-boggling, doesn't make any sense, but shows dislocation in the market, shows extreme bullish sentiment, and shows that the market is offside, and you can take advantage of that. Do what you will with that information that I just laid out, because it's very crucial. It's very obvious if you're paying attention, and if you have studied ego, et cetera, et cetera, et cetera, you're not a money manager losing this year and not caught in some trying to save a ton of money, and you've been dealing with low rates for the last decade, all this BS that is no longer the case. If you can look past all that, those weird forces, and just stick with what the Fed is saying and not fight them, keep it simple, you can really make a lot of money here because I think there's a pretty solid dislocation that's occurring right now, and we're just coasting right through. We're going to see what happens, but let's get more into the Fed because there's a whole lot of things talking about. The bullish narrative, what needs to happen in order for the market to rally and for that whole thing to work out. In order for that to be the case, The Fed needs to hike rates, see inflation come down, and make a move very quickly. This needs to happen quick, needs to happen synchronously, needs to happen without a hiccup. People did not listen, and I guarantee you the vast majority of money managers, the vast majority did not listen to Bullard and George last week at this academic talk that was 8 hours long. I didn't listen to all 8 hours. I listened to them. I actually listened to them twice because it was very dense and complex knowledge. I'm going to distill it for you, and I'm going to bring about two very crucial things that they said. I've talked about productivity on this channel. The Fed has talked about productivity. We didn't really know what that meant. We got a better understanding of what that meant. We're getting jobs data this week. No coincidence they brought this up last week. Thanksgiving week, right before. And guess what? This is not going to be solved in a day. It's not going to be solved in a day. I'm going to tell you why. Productivity. What do they mean by productivity? The average worker is not as productive right now as they were before COVID. Why? Because of excesses, yes. Money, they're comfortable. There's a lot of job openings. They're comfortable on their phone. They think if I get fired, I'm going to go get another job. Everyone's been telling them how easy it is to get a job. Job doesn't matter. They don't need to work hard. Well, guess what? That's had an impact on the economy. That's had an impact on productivity. That's hurt supply chains. That's made companies have to spend more on labor, but labor's producing less. And the Fed does not like that because that's not good. That's not good for the United States as a whole. When these Chinese people, these Indian people, they're workaholics. They're going off. Our people have luxury. They have printed money. They're working from home. They're got a million jobs, paying more money every day. The Fed does not like this. So, yes, the Fed wants to see a tighter labor market. But they don't want to just see unemployment go up. They don't want to just see some layoffs. They don't want to just see a decrease in job openings. They want to see all those things, but they also want to wait for that to have an impact on productivity before they lower rates. That's why yesterday, you heard several Fed members simultaneously talk about increasing interest rates and holding them there, not for 23, but for the first time, as far as I know, as far as I can remember, holding them there until 24. So all the bulls that want S&P 4000, that are comfortable at this level of earnings, which are going to decline, don't understand that rates are going higher than they previously expected, the Fed. Rates are going higher than they previously expected and are going to be held there until 2024. That's over a year from now. People want to say the market anticipates things 6 months before they happen. That's over a year from now. Over a year. 6 months, not a year. We got to be cautious. We got to understand the market's at a very expensive level. We're not going to fight the Fed. We're not going to get caught up in the mainstream narrative by these fund managers who are down, 90% of which are down this year, hoping for a year-end rally. We're not getting caught in that. We're sticking with the Fed. We're sticking with the fundamentals. We're doing our homework. We know what's going on. We're ahead of the game. The market's offside. We'll see if I'm wrong. I don't know. We'll see what happens. That's today's video. Until next time, peace out.